In 2006, the Raja Garuda Mas Group was an absolute titan of Indonesian industry. Through its subsidiary, Asian Agri, the company controlled hundreds of thousands of hectares of palm oil plantations, generating enough wealth to make its owner the richest person in Indonesia. Internal control collapsed that November when the group's financial controller, Vincentius Amin Sutanto, stole $3.1 million straight from the company's vault. Vincentius fled to Singapore, but his employer's reach was global. The company launched a massive hunt to track him down, and the controller soon found himself living under credible death threats. Cornered and fearing for his life, he returned to Jakarta in December 2006 and surrendered directly to the KPK, Indonesia's anti-corruption agency. He arrived with a digital archive titled AAA Cross-Border Tax Planning. These documents detailed a massive corporate secret that had been hidden from public view for years. By attempting to barter his way out of an embezzlement charge, Vincentius handed the government the specific blueprint it needed to uncover a 1.25 trillion rupiah tax evasion scheme. Corporate crimes rely on meticulous manipulation of financial records. Every billion stolen is hidden inside ledgers like this one. Asian Agri's first move fabricated corporate expenses, recording 1.5 trillion rupiah in fake costs, effectively wiping the company's taxable profit. The company then claimed 232 billion rupiah in artificial losses from export transactions, shrinking their tax liability even further. These accounting entries created the image of a struggling business on paper, allowing the group to shield its massive real-world profits from the Indonesian government. The third and most sophisticated strategy relied on a mechanism known as transfer pricing. This process began with millions of tons of crude palm oil produced in their Indonesian plantations. The Indonesian subsidiary sold oil to its offshore affiliates below market value. The affiliates then resold it to international buyers at the high market price. The enormous profit is recorded in tax havens, out of reach for Indonesian authorities. From 2002 to 2005, this cycle drained an estimated 1.25 trillion rupiah in tax revenue from the national treasury. While transfer pricing can be a legitimate accounting tool, it was used here as a systematic method for siphoning Indonesian wealth into private offshore accounts. Proving these crimes in court triggered a 7-year jurisdictional stalemate. Investigation files bounced between the tax directorate and the Attorney General's office, stalling the case in a loop of bureaucratic delays. While the massive corporation fought the charges, the legal system focused its immediate weight on the whistleblower. Vincentius was sentenced to 11 years in prison for his original act of theft. Asian Agri sought to bypass a trial using Article 44B of the tax law. This provision allows for an out-of-court settlement, where criminal proceedings are dropped if the offender pays the required fine. This legal strategy caused deep public resentment. It suggested a justice system where corporate offenders can use their capital to avoid a prison cell, an option never available to the public. The saga reached a climax when the Indonesian Supreme Court intervened, issuing a landmark cassation verdict against the corporation. The court sentenced the company's tax manager to prison and ordered 14 subsidiaries to pay a record-breaking fine of over 2.5 trillion rupiah. Despite several attempts to appeal and resist the ruling, the group was eventually forced to begin paying the penalty in installments. The Asian Agri scandal demonstrates that a nation's wealth can be drained by accountants and spreadsheets alone. In this environment, a fearless and uncompromising tax authority is the most vital line of defense against the systematic plunder of public resources.